thanks for the introduction, Emma. And as mentioned today, we're going to do a bit of a deep dive into the world of ETFs. And before we get stuck into the history of ETFs, I wanted to start off by asking Vihari a pretty easy question, I think, but one that I think kind of gets overlooked a fair bit. So at Magellan, our tagline is experts in global investing. So Vihari, my question to you is, why global?
Well, Jack, Australians are a pretty sophisticated investor base, but the reality is that we can be quite insular when it comes to where we allocate our investments. A disproportionate amount of people are allocating their investments just to Australian companies. But Australia is only 3% of world markets, so there's literally the big wide world out there. And investing offshore gives us access to the world's best businesses. It gives us access to mega trends that you can't necessarily get access to here in Australia. And a lot of people have this argument that they're really unfamiliar with global companies, or compared to Australia, Australia's safe. But the reality is that, certainly for me, I'm way more familiar with Nestle or Louis Vuitton or Microsoft or Facebook than I am with how to mine, aluminium out of the ground.
Yeah.
So, these companies are familiar to us. We may as well invest in them.
Yeah. So ETFs have done a pretty great job in giving Australian investors access to global markets. It might actually surprise some of you, but the first ETF was actually created back in 1990, so 32 years ago. It came out of Canada. It was the Toronto Stock Exchange, the TIPS 35. But what was interesting is it gave access to investors to that index, but they could actually buy it or trade it like any other security. Today, that market has absolutely exploded. So I'll read you out some of these numbers. There's now, in the global ETF market, there's 10,360 different products, 21,291 listings, assets of just shy of $10 trillion. There's 642 providers globally, listed on 80 exchanges in 63 different countries. Wow, it's massive. But I'm going to highlight that not all of those are passive index ETFs. So Vihari, my question is, can you talk me through maybe some of the pitfalls or issues you see with index investing?
For sure. First up, passive investing is a wonderful thing. It gives people, really low cost access to the market, which you can then, tap into for a long period of time. But something that people don't necessarily appreciate is with an index, there's been lots of studies done on this, but 66% of companies within an index actually fall out of the index over their lifetimes due to what they call catastrophic failure. That means the share price of that company, or those companies rather, falls by more than 70%, and then they fall out of the index. So that doesn't necessarily happen every single year, but that's over the course of time, that's what's happening. And what that means is that the average stock is underperforming the index. The median stock is underperforming the index. So when you buy an index, you are getting the cream of the crop, but you're also getting the bad and the ugly, the losers within the index as well. Winners drive more than 100% of market performance. And then when you think about, there's other elements here, indexes use market cap, which means you pay more for something, the more expensive it gets. And then a lot of these other sort of smart beta strategies and things, they don't necessarily take fundamentals into account, they don't take management into account, and then they look backwards in terms of how a company's done in the past versus how it might do in the future.
Okay, so I'll give you a blank sheet then, right? What do you do to try and fix some of those problems?
So really, you want to get to a position where you are really positioning your portfolio towards those winners, and away from the losers. Our philosophy at Magellan is really to invest for the long term. Invest in companies that are going to compound your wealth over a long period of time. And doing that when you are young is an amazing thing because you've got time on your side for those forces to play out. And it's really about finding businesses that have a competitive advantage and buying those at reasonable prices.
So there's a fair bit to kind of dive into there, but let's start with this competitive advantage, right? And for anyone that has read anything from Warren Buffett, you're going to know about an economic moat. But for anyone that doesn't, can you talk us through what a competitive advantage is and maybe a couple of examples?
Sure. So, when we talk about an economic moat, you think about a business as the castle And then the moat is the protection around of that castle. You know, it's there to protect from the marauders at the gate that are trying to, you know, get and break down the defences of that castle. And you know, so that's really what a competitive advantage is. It's trying to work out what are the constituents of that moat, what drives the advantage of that company, what drives the protection around that company. And there's lots of sort of typical examples you might use. You know, the first is, you know, high switching costs. You know, a great example of that is Apple iPhones. You know, if you've got an iPhone and you've got an Apple Watch and your computer's Apple and you've got 10 years of photos on there, it's really hard to extract yourself from the Apple phone. You're going to keep buying the Apple phone every 2 or 3 years and replace what you have. That's high switching costs. Same with something like Microsoft. If you're using Microsoft applications, your colleagues are using Microsoft applications, the people that you email at other companies also use those applications, it's really hard for any one individual or company to extract themselves from that. And you know, Google tried to do it with their global applications. You know, everyone knows they had a lot of money backing them, but they were unable to disrupt Microsoft. Another one is having economies of scale. That's where you can deliver a product or service to your customers cheaper than anyone else can. So a good example there is something like a Costco. You know, that's a big box retailer. You know, there's a lot of headwinds in big box retail, but these guys have scale and they use that to deliver groceries at a really cheap price to their customers. You know, Google also has a lot of scale, you know, in its search engine that enables them to deliver the product, you know, cheaper and better than everyone else. A strong brand is a really important source of advantage as well. If you think of, you know, luxury companies, alcohol companies, companies like Coca-Cola, those brands have lasted the test of time, and that ongoing desirability means they've got pricing power as well. That's a really big advantage, particularly in the inflationary environment we find ourselves in now. And then there's network effects as well. That's probably one of my favourites. That's where you have two sides to a market, and those two sides strengthen and reinforce each other. So, you know, Visa cards is a good example there. You have, you know, the more and more people that you have using cards, the more and more shops want to accept cards, and on and on it goes. And so social media can be another source of network effect as well. Again, if all of your friends weren't on there and if all of the businesses that you follow weren't on there, you wouldn't want to be on there. You know, so that network strengthens itself.
Can we maybe flip that around a little bit then? So we've got some good examples of economic moats. I'm sure there's plenty of businesses out there, particularly in indexes, that don't have an economic moat. If I kind of think historically, I'm going to come up with like Kodak and Nokia and the obvious ones, but maybe some examples that are still available today?
Yeah, sure. Like one of the examples I really like to give is in the food space, because people see food as a super, you know, it's a staple, it's a really defensive sort of category. I've got two examples here. One is Nestle, which does have a moat in our mind. You know, they have 85% of their brands positioned as the number 1 or 2 desirable brands in their categories. So they have enormous amount of market share. They're twice as big as their next competitors. They can outcompete them in very defensible categories as well. They're in coffee, they're in pet care, they're in infant nutrition. Those are growth categories as well, in which they then dominate. On the other hand, you've got a business like Kellogg. They've got less than 40% of their brands are number 1 or 2. In fact, in the majority of cases, they're worse than 2 in terms of their position. So when it gets to an online sphere and you're comparing prices, they don't have that same pricing power because they don't have that same desirability. And then the other thing coming at something like a Kellogg is health and wellness. Like, not everybody is on the health and wellness bandwagon, but the reality is people are eating less sugary cereals, and that means these guys have a serious headwind ahead of them and they're going to struggle to grow. So you've got two businesses that defensive, they're food staples, but their futures look very, very different sitting here today.
So earlier on you kind of touched on backwards looking as a bit of a disadvantage for some smart beta funds out there. So again, let's try and turn that around and look at forward looking. I think the big word that everyone gets thrown about all the time is disruption, right? It doesn't matter what industry you're in with it, but particularly in investing, it's something that we need to focus heavily on. How do you factor that in when you're looking at a business and trying to analyse it?
Well, yeah, look, the first thing is competitive advantages are not set in stone. You know, the world changes all the time. It changes on companies all the time, you know, changes in consumer behaviour, you know, competition, new technology comes along. These, are competitive threats for existing businesses, but the reality is if it wasn't easier for us to hop online and get our entertainment and get our news, we wouldn't have all shifted to doing that. So the reality is it's making our lives better. There's nothing sinister about it. It's just the way the world works. Video killed the radio star. It was like the song back in the, whenever it was, 80s or 70s or whatever. And that's just a reality of how businesses work. Charlie Munger famously said, the best horse and carriage companies back in the day were disrupted by the invention of the car, and on it goes. So, the one thing that we've really noticed at Magellan is that digitization is accelerating that shift. And making those changes in our lives happen faster and faster. And there was a study done by McKinsey that said back in the 50s, the average life of a company was 60 years, and now that's reduced to less than 20 years. And they're forecasting it's going to approach closer to 10 years in the next 20 years. So it's
the word I
faster
pick
and faster.
up from there as well is digitisation, right? And is that the only kind of disruptive force that we've got to be worried about?
No, I mean, that's obviously a really major one, and that shift to digital consumption of entertainment and news has been a big thing, and is still yet to come in many ways. But we've also got e-commerce, we've also got automation and robotics, paying for things digitally instead of with cash, which, believe it or not, is still a big tailwind because around the world, 80% of payments are still cash and check.
Yep.
But then there's also things like sugar consumption, reducing, plant-based foods. Those things are also big mega trends, and they can prove to be, pretty big tailwinds for some companies, but they can be a massive headache for others. So the question that we ask ourselves is, has the company left a disruption gap? Have they left a gap in the market where an innovator can come in and start eating their lunch? Can the marauders, break down that moat? And what companies need to do often is that they need to keep innovating to stay a leader. Being big and being an incumbent sometimes can be a disadvantage if you sort of rest on your laurels. So you've got to keep innovating and disrupting yourself often. And what we sort of then look for, I've sort of got 4 kind of categories in terms of the types of companies I look for. One is finding technology winners, tangible technology winners where you can hang your hat that this is the advantage, this is the tailwind that they're participating in and going to take advantage of.
Yep.
Then there's the resilient businesses, the ones that you're going to keep consuming and participating in regardless of how the world changes. Yep. That's your coffee consumption, your restaurants, your cosmetics. Then you have businesses that are in really traditional industries but are unique. So that's where the Costco comes into it. Big box retail has headwinds, but Costco has a unique position that we think it's going to continue to benefit from in years to come. And then the last is what I would call innovative companies within traditional sectors. So the example I give you there is robotic surgery. There's a company, Intuitive Surgical. They are, the leaders. Robotic surgery is only 2% of all surgeries, but they are the leaders within that, and that's sort of something that they all benefit from.
So, disruption is obviously a big one, but is that the only way that businesses fail, or is there other things we've got to be keeping an eye out for?
Yeah, look, that is a big way that businesses fail. Recessions clean out a lot of companies as well. But other than that, the big thing that happens is, management can mess things up. Does management fail to innovate? Does management fail to disrupt themselves? Was there fraud? Those are the classic reasons that companies can go under. And I would say also that sometimes exogenous things can happen. Regulation, pulls the rug out from under a company, or there's a geopolitical or commodity shock or something like that that also can hurt a company. And 40% of companies do fail, within any 1 year as well within those stats.
So if I go back, the 4th thing you mentioned or earlier on was the value, right? The value of a business. And it's pretty interesting, you said it yourself, that as a business, as the price goes up, its market cap becomes bigger and becomes a bigger share within the index. And then all of a sudden you're owning more of it. To me, that sounds a little bit counterintuitive. Do you want to talk us through kind of how you think about or how you assess and then implement value? And is it just as simple as understanding a PE ratio?
Sure, look, I think I completely agree. Market cap doesn't make a lot of sense to a fundamental investor like myself. Valuation does matter a great deal. I've got a bit of a fun fact. If you had bought the index back in 1929, it would have taken you to the mid-50s to get your money back. if you overpaid essentially back in 1929. And then I've got another fun fact, which is back in the tech wreck, when the market fell by 20%, the index fell by 20%, the average stock was up by 20%. So even in a disruptive market like that, there were still valuation opportunities available in good companies where the market hadn't got in over its head. So those things are important. PE ratios are useful in many ways, but there's just so much more to it than that. That's just one number that's trying to capture what we're trying to judge, which is what are all of the future cash flows of this company. That's what you're really buying, that's what you're valuing when it comes into that. And so we're looking at what's the predictability of that, what is that worth today, given the level of inflation, given the level of rates. So there's a lot of detail that really goes into working out what those businesses are worth. And market cap, absolutely, where you pay more for something, the more expensive it gets, absolutely doesn't necessarily make sense to me.
Okay. So today we've kind of found a bunch of winners, or what Magellan would call quality companies, with economic modes. We've kind of looked at the disruption piece and valuation. Is it then just as simple as kind of throwing them all together in a portfolio, market weight or market cap weighting them, or how much is too much diversification? What's the right terms in terms of concentration to still add value over what an index is going to do? And I suppose the cheesy line behind that is, how do you have your cake and eat it too?
So look, we have thought about this a lot at Magellan. What we are really seeking to do, we have our core series of portfolios. What they are seeking to do is really identify through fundamental analysis which companies are going to be the winners over the course of time. It's a portfolio of about 80 companies, focused on the winners, away from the losers, trading at reasonable valuations, and with a focus also on the businesses that have the ability to compound returns for investors over time. And again, being young, the ability to compound and again avoid losers is a great way to be successful over the long term. So that's what we have there. And just to add in a little plug there, those funds are at a significant discount to our larger flagship fund that's at 50 basis points.
Cool. So Vihari mentioned earlier Diageo, and so Emma's going to come back up on stage in a moment. We're going to do a bit of a game of heads or tails for a nice bottle of Casamigos tequila, which is a Diageo brand. Actually, they bought it off George Clooney, I think, in 2017. But just to wrap this session up, I kind of want to leave you with 3 points when thinking about today's session. The first is, ETFs are a really good and easy way to gain access to global markets. But I think at the same time, not all ETFs are created equal. And so then I'm going to end it with a bit of a shameless plug and saying that Magellan has come up with our own kind of cost-effective ETF, actively managed, the Magellan Core Series. You can see them hopefully up on the board there behind us. But if you want to know more about them at all or how we do what we do, Vihari and I and the rest of the team will stick around after this session. Or you can look them up on the website or just look the codes up as well. But Emma, take it away.
Okay guys, we're going to do a quick game of heads and tails. And as per Jack's comment, what is on offer is a bottle of Casamigos tequila, which unfortunately I can't give you because I got in trouble for giving the last one away. But you can come and see me and I can give it to you on the way out, or I can mail it to you, whatever's easiest. So we all know how heads and tails works. If I'm going to give you a question, there's 2 answers. If you think the answer is heads, you put your hands on your head. If you think it's tails, you put your hand on your bottom. I might just get you all to stand up, if that's okay. If you are out, you then sit back down again, and then we get to the final round. Okay. You look so unexcited about this. Come on, you're going to be okay. It's going to be this tequila at the end of this. Okay. How many companies with a market cap of over $1 trillion in the world? Heads 4, tails 5. Well done. Okay, the answer is 5, tails. If you're out, sit down. Okay, see, it's getting tricky already. How many companies with a market cap of over 100 billion in Australia? Heads 3, tails 4. The answer is heads 3. So everyone else sit down. Okay, excellent, we're getting there. Okay, how many ETF providers are there in the world? Heads, 600. Tails, 700. Answer's tails. How many we got left? Okay. What year did the first active ETF come to market? Was it heads 2008, tails 2015? Heads, 2008. Okay, we're also, okay, we didn't get anyone out with that one. Okay, what proportion of stocks underperform the index? Heads, over 50% or tails over 60%? Tails is the answer. Oh, did you change to heads? Tails is the answer. Okay, what ETF is larger? Heads, the Vanguard Value, which is VTV, or tails, Vanguard Growth, VUG? The answer is tails. Who's left? Who's still standing? Oh, you two, quick, come up here. Quick, you got to come up. Very, very quickly, it's down to the final two. Okay, it's Battle of the Titans. Okay, what percentage of the S&P 500 is information technology? Is it heads 28% or tails 36%? Okay, tails. No, actually, you're both out, it's heads. So, but anyway, it was a tie. Okay, pick something different to each other this time. What percentage of the ASX 200 is energy, materials and financials? Is it heads 65% or tails 55%? Tails, you win! Come and see me afterwards, I'll give you the bottle. Thank you very much.
Equity mind.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.